Central banks around the world are busy cutting interest rates to ease the pain of the trade wars and to tackle the new world of low inflation. But will this create lasting stability or just amplify the cycle? Some thoughts on the impact for stock markets, for house prices, and for our economic outlook. With the United States back in rate cutting mode after 10 years of steady to high rates, and Europe set to unveil a stimulus package in September, the race is on for central banks to support their economies and at the same time try to weaken their exchange rates. And apparently everyone has to join in, including our Reserve Bank. Trade wars are undoubtedly the main cause of the global slowdown, but other geopolitical risks are being seen via the UK and the EU with Brexit, in the oil price with the Iranian tensions, and in the high price of gold, thanks to a range of other tensions, and due to low global inflation. Our inflation rate is still well below the Reserve Bank's target band of 2 to 3%, which RBA Governor Philip Lowe stressed last week remains one of their key focal points. Lowe also said that we should expect an extended period of low interest rates, which doesn't necessarily mean they will decrease them again next week below 1%, but it does mean they won't be going up again for some years. So, what impact will stubbornly low interest rates have on asset prices? For stock markets, we've just broken back above our previous record high set in Australia in late 2007. But the US markets have been running even hotter, with the Nasdaq above 8,300 for the first time on record, 6.5 times their GFC lows, while our market has increased just 2.2 times over this period. From here, stock markets might be getting more expensive, but if the risk-free rate keeps falling with ever lower bond rates, the valuations can get inflated. So, volatility may pick up, if we haven't had enough of that recently already. For investors, the temptation away from the safety of cash will be tested. Similarly for housing markets, borrowing rates, both fixed and variable, have fallen again thanks to the RBA, so the 12 to 15% fall in the two largest capital cities from their 2017 highs may be levelling off. The falls were less dramatic elsewhere, other than Perth and Darwin, who bore the brunt of the commodity cycle. But some regions actually rose strongly, even while Melbourne and Sydney had their largest fall since World War II. But from here, low interest rates, the recent tax cuts, and less policy uncertainty has seen a sharp rise in auction clearance rates. A more benign, steady incline for housing prices would be helpful. So, all eyes on the RBA next week to see if rates fall any further, although perhaps a pause for a few months would add stability and a degree of confidence. But higher rates seem years away all of a sudden, which may amplify volatility in the markets, but should support the economy and help short-term asset values, even if the medium-term impact is less permanent. And that's the market update from Bendigo Bank.